With more than 10,000 homes destroyed and more than $1 billion paid out, California's largest insurer is now requesting a massive rate hike. John Ramos on the latest blow for homeowners.
You may be surprised to hear that California has some of the cheapest home insurance in the country. Homeowners here pay an average of about $2,000 a year, while in Oklahoma it's 3 times that amount. But because of wildfire disasters in the last few years, and most recently in Southern California, that's about to change. It's been less than a month since wildfire decimated entire neighborhoods in Pacific Palisades and other communities in Los Angeles, and now the losses are being tabulated. State Farm General, California's largest insurer, says they have received more than 8,700 claims and already paid out more than $1 billion from its nearly depleted cash reserves. In a letter to California Insurance Commissioner Ricardo Lara, the company said, quote, "Although reinsurance will assist us in paying what we owe to customers, the cost of these fires will further deplete capital from SFG. We are requesting that you take emergency action to help protect California's fragile insurance market by immediately approving interim rate increases on these filings, with rates to be effective May 1st, 2025. Carl Sussman, a broker and industry expert, explains the situation.
The problem is that the industry in California has pretty much been upside down for about a decade, and it's been slowly getting eroded because the prices have not been matching the exposure that we've had.
So now State Farm is requesting an average rate hike of 22% for homeowners, 15% for renters and condo owners, and 38% for those owning rental properties, no matter where they are located. The company says it needs the money to refill its capital reserve and says its credit rating has taken such a hit that State Farm insurance may no longer be accepted by some mortgage companies.
And this rate increase is really just the beginning of that. And I wouldn't say that it's so much that you're backfilling premium to be able to have the ability to pay claims, but it's really bringing the rate to where it really should have been all along, considering the exposures that we have here. And now we're going to start seeing all of the carriers starting to do that. So we're not in a situation when the next wildfire comes where companies are running out of money and having to look to see how they're going to pay their claims.
But Harvey Rosenfield, who wrote Prop 103, the Insurance Consumer Protection Initiative, says he doesn't buy the hysteria. He says State Farm already had a request into the state for a 30% increase in June, well before the LA fires.
Now that the wildfires have happened, State Farm is trying to take advantage of this tragedy to say they need an immediate emergency rate increase of 22%, which could be like $750 million. We really don't know because they haven't justified that.
Rosenfield says State Farm General, the company that insures properties in California, is claiming to be broke while its parent company, State Farm Mutual, is worth hundreds of billions of dollars.
But State Farm wants to leverage with the threat that it's the biggest company in the state and its financial condition is terrible, wants to leverage a bailout. This is the forcing the public to capitalize, to fund a private corporation that has access to resources of its parent company, and it's the parent company that should be bailing out State Farm, not the public.
Who should bear the cost of the LA wildfires is one question, but there is no question that the risk of fire in California has grown in general. And it seems clear that insurers won't resume writing policies in the state until they are sure they won't be losing money by doing so.
And if the insurance commissioner approves the rate increases, which could happen in the next few days, they would go into effect when policies are renewed as of May 1st of this year.